The benefit from owning a stock or a bond comes from the cash it will bring to its owner in the future. A bondholder is entitled to receive interest payments from the company as well as the repayment of principal after the bond matures. For stockholders, future cash flows come from two sources. First, dividends paid by the company, and second, cash from selling the stocks to another investors or back to the company in the future. Regardless of whether future cash flows come in form of interest and principal or dividends and proceeds from stock sales, all of these cash flows have one thing in common: they occur in the future. Firm value is determined by discounting projected future payoffs to present value. Therefore, for all of the valuation approaches, we need a discount rate to compute the present value of all projected future payoffs. The discount rate we use depends on the payoff stream being valued. Payoffs to debt holders are discounted using cost of debt capital. Payoffs to equity holders are discounted using the cost of equity capital. Payoffs to entire firm are discounted using the weighted average cost of capital. This video describes how these different cost of capital measures are estimated. Analysts commonly estimate cost of equity capital using the capital asset pricing model, or CAPM. The CAPM equates the expected return on a particular asset as the sum of three components: the risk-free rate, the beta risk, and the stock-specific risk. The first two components are used in estimating the cost of equity capital. The third component, the stock-specific risk, is the risk that is diversified away in a large portfolio. In equation form, the CAPM estimation of a company's expected return or cost of equity capital is given as follows. The first component is the expected risk-free rate. The return on 10-year or 30-year US Treasury bills is commonly used as an estimate of the risk-free rate. The second component is the product of the market risk premium and the sensitivity of assets market return to the overall market return. The market risk premium is the difference between the expected market return and the expected risk-free rate. Market beta reflects the risk that cannot be diversified away by investing in a portfolio of risky assets. If the beta of any stock is 1, then according to CAPM, the value of that stock would move perfectly with the value of all available stock market assets. A market beta greater than 1 indicates that the company's stock price will change by a larger percent with a change in the overall market. Let's look at an example. Suppose the 10-year Treasury rate is 2.5% and the market risk premium is 5%. Calculate the cost of equity capital for company X with a market beta of 0.26. Plugging in the numbers in the CAPM formula, we get 3.8% as the cost of equity capital, which is computed as 0.025 plus 0.26 times 0.05. This estimate implies that an investor requires an expected return of 3.8% to invest in company X's stocks. The market beta computed using historical market price data reflects the firm's existing capital structure. In some settings, such as leveraged buyout, firms plan to make significant changes in the financial capital structure. In such cases, you need to project what the market beta is likely to be after the firm changes the capital structure. To do that, you can unlever the current market beta by adjusting it to remove the effect of leverage and then re-lever it by adjusting it to reflect the leverage under the new capital structure. The following formula estimates an unlevered market beta, sometimes referred to as an asset beta. The intuition behind this formula is that current market beta reflects two components. First, the systemic risk of the operations and the assets of the firm, which is the unlevered beta. And second, the financial leverage of the firm, or debt to equity ratio, net of tax benefits from using leverage. Estimating the new levered beta requires two steps. First, solve for the unlevered beta by rearranging the preceding equation to divide the current levered market beta by the term in the square brackets on the right side of the equation as follows. Second, project the new levered market beta by multiplying the unlevered beta from the step 1 by the term in the square bracket on the right side of the equation after substituting the projected new ratio for market value of debt to the market value of equity in place of the current ratio of the market value of the debt to the market value of equity. Let's look at an example. Suppose a firm has a market beta of 0.9, is subject to an income tax rate of 35%, and has a market value of debt to market value of equity ratio of 60%. If the risk-free rate is 6% and the market risk premium is 7%, then according to the CAPM, the market expects this firm to generate equity returns of 12.3%, which is calculated as 6% plus 0.9 times 7%. The firm intends to adopt a new capital structure that will increase the debt to equity ratio to 140%. What will be the new equity beta? To project the firm's levered beta under the new capital structure, the first step is to solve for unlevered beta, denoted by X as follows. Because financial leverage is positively related to market beta, removing the effect of financial leverage reduces market beta. The unlevered beta should reflect the effects of firm's operating risk, sales volatility, and other operating factors, but not risk related to the financial leverage. The new market beta is projected to reflect the new debt to equity ratio as follows. The new capital structure will increase the leverage and therefore systemic risk of the firm. According to the CAPM, this firm will face an equity cost of capital of 14.68%, which is calculated as 6%, which is the risk-free rate, plus 1.24, which is the new equity beta, times 7%, which is the market risk premium. The market rate on debt instruments is known as cost of debt capital. The cost of debt capital is usually reported in the financial statements or can be computed using the stated coupon or interest rate on the debt instrument along with the fair value of the debt instrument that is either recorded on the balance sheet or disclosed in its footnotes. We can also calculate cost of debt by dividing interest expense from the income statement by the amount of interest-bearing debt from the balance sheet. We must also consider the effect of taxes because the expected cost of debt capital is computed on an after-tax basis. Specifically, cost of debt capital is determined by the following equation. The after-tax cost of debt capital requires identifying the pre-tax borrowing rate for the interest-bearing debt and the income tax rate. Both of these should be available from the financial statement footnotes. Multiplication by the term 1 minus tax rate yields the cost of debt after the tax savings from the interest expense deduction. Cost of preferred equity capital is the dividend rate on the preferred stock. Now, in some circumstances, you may need to determine the present value of the payoffs to investments in all of the assets of the firm, not just the equity capital of the firm. Such circumstances might arise, for example, if you are considering acquiring all of the assets of a firm or are considering acquiring controlling interest in any firm. If you need to determine the present value of the payoffs from investing in the total assets of the firm or equivalently acquiring all of the financing claims on the firm, you should use a discount rate that reflects the weighted average required rate of return that encompasses the debt, preferred, and the common equity capital used to finance the net operating assets of the firm. Following is the formula to calculate the weighted average cost of capital. Here, W denotes the weight on each type of capital, D denotes the debt capital, P is the preferred stock capital, E denotes common equity capital, R represents the cost of each type of capital, income tax rate denotes the tax rate applicable to debt capital costs. The weights used to compute the weighted average cost of capital should be the market values of each type of the capital in proportion to the total market value of the financial capital structure of the firm. That is, the weight on debt and preferred stock and equity should all sum to 1. On the right side of the equation, the first term in brackets measures the weighted after-tax cost of debt capital, the second term measures the weighted cost of preferred stock capital, and the third term measures the weighted cost of common equity capital. Let's look at an example. Suppose a firm has the following capital structure on its balance sheet. The market value of the securities are as follows. $22 million worth of bonds, $5 million worth of preferred equity, and $33 million worth of common equity. The market has priced the bonds to yield 8%. The firm's income tax rate is 35%, so the after-tax cost of debt is 5.2%, which is calculated as 1 minus the tax rate of 35% times the cost of debt capital, which is 8%. The dividend on preferred stock is 4%. The equity capital market has a market beta of 0.9. Assuming a risk-free rate of 6% and a market premium of 7%, the cost of equity capital is 12.3%, which is calculated as 6%, which is the risk-free rate, plus the market beta of 0.9 times the risk premium of 7%. Using this information, calculate the weighted average cost of capital. Well, the weighted average cost of capital is calculated as follows. Plugging in all the numbers in the formula gives us the weighted average cost of capital of 9.01%. In the next video, we'll talk about dividend discount valuation model.